Investing can seem like a maze of choices, especially for beginners. This guide will take you through everything you need to know about mutual funds, from understanding what they are to selecting the right ones for your financial goals. What are mutual funds? At its core, a mutual fund is a pooled investment vehicle. Imagine a giant pot of money collected from individual investors, like you and me. A professional fund manager oversees this pot and allocates the funds into various investments, such as stocks, bonds, or other securities. By investing in a mutual fund, you essentially own a small slice of a diversified portfolio. The beauty of mutual funds lies in their simplicity and accessibility. Instead of buying individual stocks or bonds, you buy shares of a mutual fund, which gives you exposure to potentially hundreds or even thousands of securities. This reduces risk and simplifies the investment process. For example, let's say you invest $1,000 into a mutual fund. Your money is combined with that of thousands of other investors, creating a substantial pool of capital. The fund manager then uses this capital to buy a mix of assets according to the fund's objectives, such as focusing on large U.S. companies, international stocks, or government bonds. Why choose mutual funds? For many beginners, mutual funds offer an appealing combination of diversification, professional management, and ease of use. If you were to try building a diversified portfolio of individual stocks and bonds on your own, it could be time-consuming, expensive, and risky. Mutual funds take care of this complexity for you. Diversification made easy. Diversification is the principle of not putting all your eggs in one basket. Investing in a single stock is risky. If that company fails, you could lose everything. With a mutual fund, your investment is spread across dozens or even hundreds of assets. Even if one or two holdings underperform, the impact on your overall portfolio is minimal. Accessibility for small investors. Not everyone has tens of thousands of dollars to invest. Mutual funds allow you to start with as little as $500 or even less in some cases. This makes them an excellent choice for beginners who are just starting to build wealth. Professional management. Most mutual funds are managed by experienced professionals who monitor market trends, analyze financial data, and make investment decisions on your behalf. While you pay a fee for this service, more on this later, it saves you the time and effort of managing your own investments. Types of mutual funds. Mutual funds come in many varieties, catering to different investment goals and risk tolerances. Here's a breakdown of the most common types. Stock equity funds. These funds invest primarily in stocks and are designed for long-term growth. They can be further categorized by the size of the companies they invest in, small cap, mid cap, large cap, or by their geographic focus, domestic or international. Bond fixed income funds. Bond funds focus on generating income by investing in government or corporate bonds. They are typically less volatile than stock funds, making them suitable for conservative investors or those nearing retirement. Balanced funds. As the name suggests, balanced funds invest in both stocks and bonds, offering a mix of growth and income. They aim to provide a moderate level of risk and return. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500. These funds are passively managed, which means they tend to have lower fees compared to actively managed funds. Sector funds. Sector funds focus on specific industries such as technology, healthcare, or energy. While these funds offer high growth potential, they are also riskier due to their concentration in a single sector. Money market funds. These funds invest in short-term, low-risk securities like treasury bills or commercial paper. While they offer minimal returns, they are highly liquid and considered one of the safest investment options. How to choose the right mutual fund. With thousands of mutual funds available, choosing the right one can feel overwhelming. Start by asking yourself the following questions. What are your investment goals? Are you investing for retirement, saving for a down payment, or building an emergency fund? Your goals will dictate the type of fund that's best for you. For instance, if you're saving for a long-term goal, a growth-oriented stock fund may be appropriate. For short-term goals, consider a conservative bond or money market fund. What is your risk tolerance? Different funds come with varying levels of risk. Stock funds are generally riskier than bond funds, but offer higher potential returns. Balanced funds offer a middle ground. Be honest about how much risk you're comfortable taking. What are the fees? Mutual funds charge fees that can eat into your returns over time. look for funds with low expense ratios, which represent the annual cost of managing the fund. Passive funds, like index funds, tend to have lower fees than actively managed funds. What is the fund's track record? While past performance doesn't guarantee future results, it's helpful to review a fund's history. A consistent track record of meeting or exceeding its benchmark index is a good sign. The costs of mutual funds. Investing in mutual funds isn't free. It's essential to understand the costs involved so you can make informed decisions. Expense ratios. The expense ratio is the annual fee charged by the fund, expressed as a percentage of your investment. For example, if a fund has an expense ratio of 0.5%, you'll pay $5 annually for every $1,000 invested. Over time, high expense ratios can significantly reduce your returns. Sales loads. Some mutual funds charge sales commissions known as loads. A front-end load is a fee paid when you buy the fund, while a back-end load is charged when you sell. Fortunately, many funds today are no load, meaning they don't charge these fees. Where to buy mutual funds? You can purchase mutual funds directly from the fund company or through a brokerage account. Many brokers offer a wide selection of funds from various companies, giving you the flexibility to build a diversified portfolio. Direct purchase. Buying directly from the fund company is straightforward and often fee-free. For example, you can invest in Vanguard or Fidelity mutual funds directly through their websites. Brokerage accounts. If you prefer to keep all your investments in one place, consider opening a brokerage account. Platforms like Charles Schwab, E-Trade, and Robinhood allow you to buy mutual funds alongside other investments like stocks and ETFs. How much money do you need to get started? One of the great things about mutual funds is their accessibility. Some funds have minimum investment requirements as low as $100, while others may require $1,000 or more. For beginners, look for funds with low minimums to start your investment journey. The benefits of mutual funds. Mutual funds offer numerous advantages, especially for beginner investors. They provide instant diversification, professional management, and the ability to start with small amounts of money. Whether you're looking to build wealth over time or protect your savings, mutual funds are a flexible and effective tool. Managing your mutual fund investments. Investing in mutual funds is just the beginning. Proper management ensures that your investments stay aligned with your goals and adapt to changing circumstances. Rebalancing your portfolio. Over time, the performance of different mutual funds in your portfolio may cause your asset allocation to drift from your original plan. For example, if your stock funds perform well but your bond funds lag, your portfolio may become more stock-heavy than intended, increasing risk. Rebalancing involves selling some of the overperforming assets and reinvesting in underperforming ones to maintain your desired allocation. Dollar cost averaging. This strategy involves investing a fixed amount of money into mutual funds at regular intervals, regardless of market conditions. By doing this, you buy more shares when prices are low and fewer shares when prices are high, potentially lowering your average cost per share over time. Monitoring fund performance. While mutual funds are managed by professionals, it's still essential to periodically review their performance. Compare your fund's returns against its benchmark index and similar funds in its category. If your fund consistently underperforms, consider whether it's time to switch to a better performing option. Automating investments. Most fund companies and brokers allow you to set up automatic contributions to your mutual fund. This is a convenient way to ensure you're consistently investing and taking advantage of compounding growth over time. Understanding tax implications of mutual funds. Taxes are an important aspect of mutual fund investing that can significantly impact your returns. Here are the key things to know. Tax on dividends and capital gains. Mutual funds distribute income to investors in the form of dividends and capital gains. These distributions are taxable even if you reinvest them into the fund. If the fund is held in a taxable brokerage account, you'll owe taxes on the distributions each year. Qualified dividends are taxed at the lower capital gains rate. Ordinary dividends and short-term capital gains are taxed at your regular income tax rate. Long-term capital gains are taxed at the lower capital gains rate. Tax-advantaged accounts. Investing in mutual funds through tax-advantaged accounts like an IRA or 401k can shield you from annual taxes on distributions. In a Roth IRA, for example, your investments grow tax-free and qualified withdrawals are not taxed. Tax loss harvesting. If one of your mutual funds has experienced a loss, you can sell it to offset taxable gains from other investments. This strategy helps reduce your tax bill while allowing you to reinvest the proceeds into a different fund. Final thoughts: a simple yet powerful investment option. Mutual funds are a cornerstone of modern investing, offering a straightforward way to build a diversified portfolio. By pooling resources with other investors, you gain access to a professionally managed collection of assets, reducing risk and simplifying the investment process. For beginners, mutual funds provide a perfect balance of accessibility, diversification, and professional oversight. Whether your goal is long-term growth, income, or stability, there's a mutual fund to match your needs. So take the first step, do your research, and start building your financial future with mutual funds.